So we are good to go with the first accounting standard, which we are going to learn. And this standard is going to be very, very important in terms of this is going to lay the foundation for the preparation of financial statements, right? So the importance of this standard is where you will understand the basics that will be required when you are preparing financial statements, right? So uh, in your respective organizations, you might not end up preparing financial statements. Not everybody, but there could be people who might prepare financial statements. But more than that, what is important is to understand how these present financial statements will look like. Okay, so the standard LKS1 is the one which is going to give that foundation, right? So whenever we talk about a accounting standard, how do we name it? Now in examination, you will see when we do the past papers, you will see there might be questions which may require you to write the name of the accounting standard. Write the name of the accounting standard. There had been questions where just for writing the name of the accounting standard, you will get 5 marks. Okay, so just imagine, just to write LKS1 presentation of financial statements, you might get 5 marks. So it is very important, whatever the standards that we learn, you understand how the name of this accounting standard is, right? And most importantly, whenever we talk about an accounting standard or naming an accounting standard, how we say about it is we say Sri Lanka accounting standard, Sri Lanka accounting standard, and then only we give the name. So when you talk about the name is given in 2 ways, right? The name has two forms. So that is what we need to understand better, right? So what you need to know is actually you can see the board, right? Is the board visible?
Yes, sir.
Right. Now, when we talk about an accounting standard, the standard will be given as Sri Lanka accounting standard, and then only you give a naming convention, and then only you will give a naming convention. Now, what is this naming convention? That is very, very important, right? So if you look at the conceptual arrangement here in Sri Lanka, you know that we have the Institute of Chartered Accountants in Sri Lanka. So we call them as CA Sri Lanka. Generally, they are known as CA Sri Lanka. They are the ones who are setting standards. The accounting standards are set by them. But from where do they get those? So Sri Lanka is also a representative in the IASB. We call it as IASB, that is International Accounting Standards Board. International Accounting Standards Board. So we represent in the International Accounting Standard Board. So we have to be proud actually. There are a lot of accountants today, chartered accountants, who are holding key positions in this, right? And they make a lot of representations from the Sri Lankan business context also. So the accounting standards are built here in the IASB, right? So these accounting standards are adopted by the member countries. Like Sri Lanka is also adopting those standards with slight variations wherever necessary, which are incorporated by the CA Sri Lanka, and we will adopt those accounting standards. So we go as Sri Lanka accounting standard, right? If you look at the international version of it, it goes as international accounting standard. International accounting standard. So what happens here when you look at the international accounting standard, it stands like IAS. Okay, so the standard that we are going to look at today, you would have seen it goes as LKAS. LKAS. So what does it mean? LKAS. Now here AS means accounting standard. Accounting standard. So here also AS means accounting standard. So what is differentiated here? The I here stands for international accounting standard. So likewise, for the Sri Lanka, the ISO code for Sri Lanka is LK. LK. That's why our accounting standards are named as LKAS. So you should know why we have LKAS. If you look at international professional examinations, you might see they call it as IASs. But here, when we learn something here locally, we have a naming convention which is given by the Sri Lanka Institute of Chartered Accountants, which goes as LKAS. Similarly, internationally, we have something called IFRS, which is very popular. So here, FRS stands for Financial Reporting Standards. Here, accounting standards, there it is Financial Reporting Standards. So now, likewise, here we have the LKSs. There we have something known as SLFRS. SLFRS. Now, these are of course not in your handouts. That's why I'm just taking out these information and sharing it with you. So here we have SL, which is representing the local version of IE. So here it is International Financial Reporting Standards. Here we call it as Sri Lanka Financial Reporting Standards. Okay. So throughout our lesson, that is this module, the course module, we will be talking about these two. That is what we are going to do actually. So your focus should be what are the LKSs and SLFRSs that are relevant to us with regard to this syllabus content, right? What are the LKSs we need to know and what are the SLFRSs we need to know? Because if you look at for the Sri Lankan business context, we have various types of businesses. So in order to address all those businesses, we have so much of LKSs and SLFRSs. So we will not learn all in this course, right? So for example, there is one accounting standard which talks about biological assets. Now, for us, it may not be relevant. So we will not go into detail into the biological asset standard. Okay. So likewise, we have certain predetermined standards which are being tested, and we will go through those. So out of which today we are going to look at LKAS 1. LKAS 1. So how does it go? When you are writing the name of the accounting standard, we have to say Sri Lanka, as I told you earlier, accounting standard, right? Then you have to continue with that. LKAS 1, where you will say presentation of financial statement. So that is how you name an accounting standard. Likewise, every accounting standard, when we learn, we will go by the code and the name, but when you are writing it, you have to add this term, Sri Lanka Accounting Standard. That clause needs to be added along with the coding that you have. Okay, so you can take down this if you want, just for your information. Okay, right. So let's get back to the topic. So we are going to look at LKS1, presentation of financial statements. So what is the main objective of this standard? This standard prescribes the basis for presentation of general purpose financial statements. We call it as general purpose financial statements to ensure comparability with both with entities' own financial statements of previous periods and with the financial statements of other entities. So you will see here there is an objective of LKS1. What is the objective? Where LKS1 tries to compare its financial statements with its own financial statements of previous periods. Now we are in 2021. So let's assume that a company with a financial year starting from 1st of January to 31st December. So now you know what is a financial year is, accounting period. So financial year is going to be 1st of January and ending on 31st December. Right? So we are in the financial year of 2021. Now somebody preparing financial statements for 2020, of course the time has already lapsed. We are now in August. So the financial statements, if it is for a bank, it should have been prepared within 5 months from the year end. Okay, so 31st May was the deadline, but there had been some exceptions because of COVID-19, but now the time has already lapsed. So if you look at the preparation of a financial statements for the year 2020, what does this mean? It means that the company should prepare financial statements or present financial statements where it could compare with the entity's own financial statement of previous period. So when you are preparing financial statements for 2020, it should be comparable with your financial statements prepared for 2019. Do you understand that? So if you are preparing for 20, it has to be comparable with the 2019. Now towards the or after the end of this year, that is when we get on to 2022, we will be required to prepare the financial statements for 2021. So if you are preparing 2021, it should be comparable with what you have prepared already for 2020. So LKS1 always thrives to achieve this objective. It wants to ensure that people prepare financial statements which are comparable with its prior period. Okay. And on top of that, it also focuses on comparing the financial statements with other entities. Now let's say you are a bank, let's say you are ABC Bank. So if you are ABC Bank and preparing your financial statements for the year 2021, your financial statements should be comparable with LMN Bank or PQR Bank, whatever. So your financial statements should be comparable in two ways. What is one? It is with your own company's prior periods. Secondly, it should be comparable with other entities or other companies. Those are the two main objectives of LKS 1. What is general purpose financial statement? I'll come to that in a short while. So it also sets out the overall requirements for the presentation of financial statements, guidelines for their structure, and minimum requirements for their contents. Now, when you look at the financial statements of Sri Lankan companies, they have a specific format. This we call it as the structure. So who has given this structure? Who has given this structure? Any idea? Do you all know who has given this structure for the presentation of financial statements? Anyone? Yeah. So when it comes to central bank, they can give only to whom? For the banks in this country. Banks in this country. That is, it could be a licensed commercial bank or specialized savings or licensed specialized banks. Okay, it could be for a commercial bank or could be for a specialized bank. Now, why they have to give the format? Otherwise, what will happen? Every bank will prepare their financial statement in their own format, which is not acceptable or preferred. Because when you are preparing financial statements, it should be like where comparable. We already have gone through that term, comparable. So when you want to compare, someone else should look at those financial statements and say, look, everybody should have this format so that people can compare across the companies. Okay. But for the listed companies, there are formats given by the standard. The standard accounting standard specifies certain templates, which are also vetted by the Colombo Stock Exchange. So they prepare financial statements based on the formats provided by the accounting standard. Okay, accounting standard. So why I'm stressing this point is when you are looking at your examination paper, the question number 1 talks about preparing financial statements. And so far, what I have observed from the past papers that have come so far, every time the examiner has tested on a presentation of or preparation of financial statement of a bank. So that is very interesting. So most of you all are working in banks. So as a result, you should know how the financial statements look like of a bank. And here comes, we are going to learn how to prepare the financial statements for a bank and what is its format also. Okay, so that we will do towards the latter part of this course because we have a lot more to learn, right? To achieve into that level, we need to complete so much of other requirements or subject components where it takes us to that particular stage. So what is general purpose financial statement? General purpose financial statements are those which are intended to meet the needs of the users who are not in a position to require an entity to prepare reports tailored to them. Now, everybody who visits your bank or who come to your bank cannot ask to prepare a financial statement catered to them. Now, say for example, there is a depositor. So the depositor is coming to your bank to deposit money, but he wants to know whether it is safe or is there any risk in me coming and depositing money in your bank, right? So for that, he wants to look at your financial statements. Now that customer cannot ask the bank to prepare financial statements for his requirement, his or her requirement, because the bank cannot be preparing financial statement for every person who is coming to the bank or who is interested in the bank. But commonly, we have to follow certain principles and prepare financial statements so that whoever doesn't have access to financial information of an organization can look at these financial statements. So that is why the central bank today, or maybe it has been happening for a long time, request the banks to publish their financial statements on a quarterly basis in the newspapers. Why that is done? So that every public or every citizen in this country have access to look at the financial performances of the banks. Not only ABC Bank, but any bank. Any bank that is operating in this country will have to provide financial information in the form of newspapers when it comes to preparing financial statements. So the central bank has a regulator. As the regulator, they have insisted all the banks to prepare and publish in the newspapers so that they have access. Now, what happens to other companies? There are so much of other companies which are operating in Sri Lanka. So how does people will get to know information about those companies? What do you think? Anyone? How can they get information? Any responses? What do you think? How companies, other companies can provide financial information to their, I may call it stakeholders. We don't call them shareholders, but stakeholders. What do you think? Anyone? Very good. They provide their financial information via the company's websites today, right? Most of the companies make use of their website as a marketing tool. So this marketing tool is obviously giving access to information to all the public. And on top of that, there is another tool that is being widely used by companies today, which is the annual report of the company. Every listed company will prepare an annual report, and that is publicly available. Publicly available. So, as one student said, that you have access to the company's website, which is a common in the common platform. So when you go to the company website, they have already put down their financial statements. On top of that, you can go to the Colombo Stock Exchange website, where they will show all the listed company, their details, news, financial statements, so much of things are there. So as the regulator of companies, the Colombo Stock Exchange also plays a vital role in disseminating financial information to the public of this country. Okay, so what does general purpose financial statement means? For those who doesn't have access, now you being an employee of your bank, you have access to the financial information of your bank, but not everyone outside will have that access. So that is why the general purpose financial statements are prepared. So why do we prepare financial statements? That is to provide information about the financial position of a company, the performance of a company, and of course, its cash flows. Its cash flows. So those are the three important elements. Those are the three important elements that we need to look at when it comes to preparing financial statements of a company. Preparing financial statements of a company. So what are the three things? What are the three things? The financial position, that is the balance sheet. We call it as the balance sheet or the statement of financial position. The second one being the performance, financial performance. What is financial performance? That is the profit or loss. The profit or loss of the company. So how do you measure the profit or loss? You prepare a statement for that. That is profit or loss statement of the company. We will look at it shortly. Then most importantly, you will have the cash flows. How much of cash is coming into the company? How much of cash is going out of the company? Now, right now we looked at the the cash book. There are cash receipts and cash payments. So these cash receipts and payments need more information for the public to understand. How do we give that information? That is by way of a cash flow statement. So we are basically talking about three financial statements here. One is the financial position, secondly the performance, and thirdly cash flows of a company. So why you prepare financial statements? To provide information about the financial position, performance, and the cash flows of an entity. It also reflects the results of management stewardship. Please note the term management stewardship. What do you mean by management stewardship? Please, as I explained in our first chapter, the companies are managed by a team called board of directors. They are the ones who are taking decisions on behalf of the company, giving the strategic direction, and all those are taken care of by them. So the management stewardship means how they govern the organization, right? If they are not managing properly the organization, those will get reflected in the financial performance and the position, right? If a company decisions are made poorly or badly, it will have a direct impact in the company's performance. If the resources are not managed properly, that will have an impact on the financial position of the company. Let's say there is a mismanagement of cash, what is going to happen? The company is going to struggle in terms of liquidity. So the financial statement also reflect the governance of the management. When you say management, it includes the corporate management, senior management, and the board of directors, the highest authorities in an organization. Okay. What are the objectives of financial statement? Now we are going into the objectives of financial statement, right? Initially we looked at the objective of LKS 1. Now we are looking at the objectives of the financial statements, right? Now the financial statements is actually looking at the information relating to the following aspects of a company. What are these aspects? Many of them are already known to you. You have the assets, you have the liabilities, you have the equity, that is the capital, reserves, and so on. Then you have the income and expenses. You also have the transaction between the owners. What do you mean by contribution by and distribution to owners? One is where you ask for capital from the owner, so they will give you capital. That is a transaction with the owner. Then when you make good profits, what do? You distribute dividends back to them. That is again a distribution to the owner. You distribute part of your profits to the owners of the company. So the financial statements expect you to provide that information. What are the transactions that you have with the owners of the company in terms of receiving from them and whatever giving back to them? And most importantly, the cash flows. What are the cash inflows? What are the cash outflows? Very, very important. The financial statements. So when you prepare financial statements, a company is required to prepare the financial statements that are listed on this particular slide. What are these financial statements? Number one, we call it a statement of financial position. A statement of financial position. As at the end of the reporting period, we now call it as at the end of the reporting period, which means you are preparing a balance sheet which provides information relating to your assets, liabilities, and equity. That is what you saw here. That is what you saw here. Assets, liabilities, and equity are reflected in your statement of financial position. Statement of financial position. Secondly, you prepare a statement of profit or loss and other comprehensive income. Now, this term might be little fishy for you all, but this is the term that we are going to use widely going forward, right? So statement of profit or loss is known to us. We always talk about the P&L, profit or loss. But now comes a term which the new standards have introduced, which is known as other comprehensive income. Other comprehensive income. So we will learn in detail what it is. So a profit or loss or other comprehensive income is going to reflect your income and expenses. Okay, is going to reflect your income and expenses. Now you see, assets, liabilities, and equity is represented in your statement of financial position. Your income and expenses are reflected in the statement of profit or loss and other comprehensive income. What is the third statement? A statement of changes in equity. So whatever the change that is going to take place in your equity, you have to provide a detailed report, a detailed financial statement. So what is it going to have? That is going to have the contribution by and distributions to owners in their capacity as owners. So what are the transactions that you have entered into with the owners of the company? So all transactions that you have entered into with the owners during the year will get reflected in the statement of changes in equity. Statement of changes in equity. And that is also prepared for the reporting period. For the reporting period. So you have the statement of financial position as at the end of the reporting period. End of the reporting period means if your financial year is 1st of January to 31st December, We are providing the statement of financial position as of 31st December. As of 31st December. But when we talk about a statement of profit or loss and other comprehensive income, or a statement of changes in equity, that is for a particular period, that is your financial year, which means that we are talking about from first of January to 31st of December. That is why we say for the reporting period. Now, first one you will see as at the end of the reporting period. This one is for the reporting period. And lastly, very important, your cash flows. Your cash flows are reflected in a separate statement called a statement of cash flows, which is again for a reporting period. Okay, so we have basically four important financial statements: a statement of financial position, a statement of profit or loss and other comprehensive income, a statement of changes in equity, a statement of cash flows. When it comes to the examination, the statements 1, 2, and 3 are part of your question number 1. The question number 1 of your paper, which is a compulsory question, tackles on the first 3 statements. So you should be conversant enough to prepare those 3 financial statements as part of your question number 1 in the examination. The statement of cash flows, of course, is governed by a separate standard. There is a separate accounting standard, which is LKAS 7. LKAS 7 is on statement of cash flows. That is actually an optional question. You might get or might not get. I'm not quite sure about it. So it's a separate question, essay type question, where you will get for 20 marks. Okay. So statement of cash flows will be our last topic. During this course, we will learn the last topic would be statement of cash flows. Why we do it last is, by the time we do the statement of cash flows, we should be 100% thorough with all what we have learned. Because the entire thing that we have learned is going to get reflected in the statement of cash flows. So the knowledge what we have from all the other will be very, very important to prepare the statement of cash flows. So that will be our last topic when it comes to this particular module. Okay, so let me show you how these statements will look like. Okay, so we looked at the first one. We call it as the statement of financial position. So that is FFOP, right? Statement of financial position is in short form known as SOFP. The second one, actually, I will explain it later. You saw that there is statement of profit or loss and other comprehensive income. Statement of profit or loss and other comprehensive income. But there is a common statement which is known as SOCI, which is the statement of comprehensive income. Statement of comprehensive income. Statement of comprehensive income, right? So the statement of comprehensive income has two components. One is the profit or loss. The other one is the other comprehensive income. We will go into detail when we look at those. Third one, statement of changes in equity. Statement of changes in equity. Give me 1 second. There is a question. Sorry about it. There was a mistake that I did. I was presenting the earlier one, and then the board, I think the letters got inverted. So now I think it should be okay. Right. So statement of financial position, statement of comprehensive income, and the third one we learned, that is statement of changes in equity. Statement of changes in equity. Statement of changes in equity. And the last one, statement of cash flows. Statement of cash flows. So you need to know these short forms. You need to know these short forms because we will have to use these as it is in the examination, as well as when we learn, we will use it as it is. So I might call it as SOFP, SOCI, SOCE, SOCF. So you should know what it is. What am I referring to? Okay. So the SOFP is basically the balance sheet. The SOCI is actually your P&L. Okay, those are the two new terminologies that came in with the introduction of new accounting standards. For the balance sheet, we have now statement of financial position. For the P&L, we have statement of comprehensive income. Okay, so please make a note of it. Right. So in addition to the financial statements, you need to provide some additional information. Now, what are these? As I told you, the additional information include providing the comparative information, providing the comparative information, comparative financial information. Then we might also sometimes make adjustments to the financial statements where we would have made some mistakes in the previous years. We would have made some mistakes in the prior years, but we now want to correct those. So when you correct those, it is called in accounting as you have to prepare them or adjust them retrospectively. Retrospectively. Okay. The term is there, retrospective adjustments. When you do some adjustment of that kind, you have to go and adjust your financial statements. Now say you go and you would have been doing a mistake from 2005 to 2019, but you identify your error in 2020. So what you need to do, when you go and do this correction in 2020, you have to go back and adjust your previous financial statements. So preferably if you are making a correction for 2019, because that is important since you are providing the comparative information, so you will also have to do 2018. So what do you mean by retrospective adjustment is when you have found out an error and rectify it, that error has to be adjusted going backwards. Okay, so not all the adjustments are like that. There could be certain adjustments. Say for example, later on we will learn depreciation. So depreciation has to be adjusted retrospectively. Okay, so there are adjustments like that where you will have to go and adjust retrospectively. In such instances, you need to provide the restated statement of financial position, right? As if I have corrected my financial position statement because of this error. And the last one, of course, very straightforward, where you need to provide notes which comprises summary of accounting policies and other explanatory information. So we said that we prepare the financial statements based on the accounting standards. Now, based on the accounting standards, how you have adopted them, you have to provide some information to the reader. For that, what you need is you need to adopt certain accounting policies. So accounting policies are nothing but the adoption of accounting standards. How you have adopted the accounting standards and how you have used them in your financial statements. So basically, when you look at all these listed items, this is known as a complete set of financial statements. In examination, sometimes this might be referred as list down the primary financial statements. When you are asked to write the primary financial statements, you have to write all these. If not, they might ask you write 3 financial statements, primary financial statements. So you can write the first 3 or whatever, right? So don't forget to write the first 4. First 4 is the most important. These are like miscellaneous information, but this is very, very important. The first 4, which is in bold, is very, very important. Okay. So when you are preparing financial statements, it is the responsibility of the accountant or the bookkeeper or the preparer of the financial statements to make a fair presentation which is in compliance with the SLFRS and LKS. I told you what is SLFRS is. So the 2 sets of accounting standards, you might adopt certain SLFRSs or certain LKSs. All those have to be complied with. You can't exclude anything and prepare financial statements. Okay, if you are adopting an accounting standard, that has to be adopted in full. You can't take half of it and do the balance as you like. So what does it say? Compliance with SLFRS and case is presumed to result in financial statements that achieve a fair presentation. So how can you achieve fair presentation? By way of compliance with the required accounting standards. The following points made by LKS1 expand on this principle. How? You comply with all the SLFRS and LKSs, where you have to say that I have all complied with those. Then, all relevant SLFRS and LKS must be followed if compliance with this is disclosed. As I told you, you can't do halfway adoption. Then C, use of an inappropriate accounting treatment cannot be rectified either by disclosure of accounting policies. What does that mean? Now let's say there is a requirement by the accounting standard to do something in a proper manner, but you are not doing it. You are not adopting it. But you can't be giving reasons for not adopting it. The LKS1 does not permit that. That is what it means. The LKS1 says you can't give some reasons for not adopting the standard. That is not permitted. If you say that I am adopting these standards, yes, you have to adopt them in full. You can't make clauses with exceptions. That is not permitted. So, what do? You select the required accounting standards. And based on these standards, you develop your accounting policies. Step 2, you present your financial information in a manner which provides, you have already gone through this, relevant, reliable, comparable, and understandable. So when you are presenting financial information, it should be relevant, it should be reliable, it should be comparable more than. So statement of financial position, statement of comprehensive income, and the third one we learned, that is statement of changes in equity. Statement of changes in equity. Statement of changes in equity. And the last one, statement of cash flows. Statement of cash flows. So you need to know these short forms. You need to know these short forms because we will have to use these as it is in the examination as well as when we learn, we will use it as it is. So I might call it as SOFP, SOCI, SOCE, SOCF. So you should know what it is. What am I referring to? Okay. So the SOFP is basically the balance sheet. The SOCI is actually your P&L. Okay. Those are the two new terminologies that came in with the introduction of new accounting standards. For the balance sheet, we have now statement of financial position. For the P&L, we have statement of comprehensive income. Okay. So please make a note of it. Right. So in addition to the financial statements, you need to provide some additional information. Now, what are these? As I told you, the additional information include providing the comparative information, providing the comparative information, comparative financial information. Then we might also sometimes make adjustments to the financial statements where we would have made some mistakes in the previous years. We would have made some mistakes in the prior years, but we now want to correct those. So when you correct those, it is called in accounting as you have to prepare them or adjust them retrospectively. Retrospectively. Okay. The term is there, retrospective adjustments. When you do some adjustment of that kind, you have to go and adjust your financial statements. Now say you go and you would have been doing a mistake from 2005 to 2019, but you identify your error in 2020. So what you need to do when you go and do this correction in 2020, you have to go back and adjust your previous financial statements. So preferably if you are making a correction for 2019, because that is important since you are providing the comparative information, so you will also have to do 2018. So what you mean by retrospective adjustment is when you have found out an error and rectify it, that error has to be adjusted going backwards. Okay. So not all the adjustments are like that. There could be certain adjustments. Say, for example, later on we will learn depreciation. So depreciation has to be adjusted retrospectively. Okay. So there are adjustments like that where you will have to go and adjust retrospectively. In such instances, you need to provide the restated statement of financial position. Right? As if I have corrected my financial position statement because of this error. And the last one, of course, very straightforward, where you need to provide notes which comprises summary of accounting policies and other explanatory information. So we said that we prepare the financial statements based on the accounting standards. Now, based on the accounting standards, how you have adopted them, you have to provide some information to the reader. For that, what you need is you need to adopt certain accounting policies. So accounting policies are nothing but the adoption of accounting standards. How you have adopted the accounting standards and how you have used them in your financial statements. So basically, when you look at all these listed items, this is known as a complete set of financial statements. In examination, sometimes this might be referred as list down the primary financial statements. When you are asked to write the primary financial statements, you have to write all these. If not, they might ask you write 3 financial statements, primary financial statements. So you can write the first 3 or whatever, right? So don't forget to write the first 4. First 4 is the most important. These are like miscellaneous information, but this is very, very important. The first 4, which is in bold, is very, very important. Okay. So when you are preparing financial statements, it is the responsibility of the accountant or the bookkeeper or the preparer of the financial statements to make a fair presentation which is in compliance with the SLFRS and LKS. I told you what is SLFRS is. So the 2 sets of accounting standards, you might adopt certain SLFRSs or certain LKSs. All those have to be complied with. You can't exclude anything and prepare financial statements. Okay, if you are adopting an accounting standard, that has to be adopted in full. You can't take half of it and do the balance as you like. So what does it say? Compliance with SLFRS and LKS is presumed to result in financial statements that achieve a fair presentation. So how can you achieve fair presentation? By way of compliance with the required accounting standards. The following points made by LKS1 expand on this principle. How? You comply with all the SLFRS and LKSs, where you have to say that I have all complied with those. Then, all relevant SLFRS and LKS must be followed if compliance with this is disclosed. As I told you, you can't do halfway adoption. Then C, use of an inappropriate accounting treatment cannot be rectified either by disclosure of accounting policies. What does that mean? Now let's say there is a requirement by the accounting standard to do something in a proper manner, but you are not doing it. You are not adopting it. But you can't be giving reasons for not adopting it. The LKS1 does not permit that. That is what it means. The LKS1 says you can't give some reasons for not adopting the standard. That is not permitted. If you say that I am adopting these standards, yes, you have to adopt them in full. You can't make clauses with exceptions. That is not permitted. So, what do? You select the required accounting standards. And based on these standards, you develop your accounting policies. Step 2, you present your financial information in a manner which provides, you have already gone through this, relevant, reliable, comparable, and understandable. So when you are presenting financial information, it should be relevant, it should be reliable, it should be comparable. More than that, it should be understandable. If you are giving some financial information which people cannot understand, then it is not going to be worthwhile. Step 3, additional disclosures. This term disclosure you might come across several times. Disclosure is something that you provide in addition to whatever that is required by the reader or by the standard. So additional information that you will provide is called disclosure. Disclosure. The term disclosure, we will use it over and over again. Okay. So the fair presentation and compliance could be achieved with these 3 steps. What are those? Step 1, where you develop and apply the accounting policies based on the accounting standards. Number 2, you present your financial information in a manner which covers relevance, reliability, comparability, and understandability. Number 3, providing additional information to make the reader understand better. To make the reader understand better. So, we learned something called concepts. Can you remember underlying assumptions or concepts that we learned? So, LKS1 talks about certain concepts which you need to adopt when you are preparing financial statements. What are those? One, very, very important, the going concern. You know what going concern is. So, what does it mean? Going concern is where financial statements are normally prepared assuming the entity is a going concern and will continue in operation for the foreseeable future. So going concern is a concept or assumption where we assume that the company is going to continue for the near foreseeable future, which means it is not going to stop down its operations. And you also know what is accrual basis of accounting. Except the statement of cash flows, all the other financial statements are prepared on accrual concept. Very, very important. This we will learn again when we do the statement of cash flows. The statement of cash flows is the only financial statement where you don't apply accrual principle. You don't do accrual basis of account because the objective of statement of cash flow is to find out how much of cash was received, how much of cash was paid. So you cannot apply accrual basis of accounting there to reflect your cash flows. Thirdly, consistency. The preparation of financial statements should be consistent. In one particular financial year, you do something, and in another financial year, you do something differently. No, you can't do that. You have to be very consistent with regard to the preparation of your financial statement. The presentation and classification of items in the financial statement shall be retained from one period to the next period, unless a change is justified either by a change in circumstances or a requirement from a new SLFRS. So it clearly specifies. You have to be consistent in preparing your financial statements. You can't make classifications randomly. If you do ad hoc classifications, what will happen? The financial statements will lose its consistency. The reader will get confused with regard to what you have presented. Last year you are saying something and this year you are doing something differently. The people or the reader or the decision maker will get confused. Then we also look at the materiality. The information that you have provided, how material it is. Or the information that you have not provided, how material it is. If you have not provided a valuable, most important information in your financial statement, which is going to have a very serious impact on the decision made by the reader or the decision maker, that is called materiality. So every information that you provide in your financial statements should be looked at in terms of materiality. Then we also say aggregation. In financial statements, sometimes we might have to group certain information. Like we call them as by class. So what do? We group them together to show a correct picture. Mostly what we do is we will group similar items. But dissimilar items should not be aggregated. Now say for example, I will give you an example. let's say property, plant and equipment. In an organization, you might have property, you might have plant like machinery, and you might also have the equipment which are used in your organization. Now the property, plant and equipment, you do not segregate them separately and present in your financial statement. You can group them together and show it in your financial statement. That is known as aggregation. So you will give a total without giving a detailed breakdown. The detailed breakdown can be given as part of the notes to the financial statement, right? So you need to start looking for financial information provided by companies in the respective organization websites or maybe from the Colombo Stock Exchange. What you can do, the first thing is, of course, now you are under quarantine curfew. So when you go back to your organization, or maybe if you are working during this period, just try to have a look at the annual report of your company. Go to the section on financial statements and look how the financial statements are presented in your annual report. Or you can, of course, look at it from the websites as well. Okay, if time permits, we will have a look at the financial statements from the website today. Then we have offsetting. So offsetting is basically where assets and liabilities and income and expenses, where you try to net off them. But the accounting standard is very clear. The accounting standards say you should not set off or offset any asset or liability or income or expense. Now let me give you an example. Let's say you have accepted a deposit from one of your customers. Let's say 10 million. You have accepted a deposit of 10 million from one of your customers. So now in your books, you have deposits of 10 million. Later on, this customer comes and asks for a loan. He asks for a loan of 5 million, let's say. So now you have a loan of 5 million. So now, if assuming that these are the only items in your balance sheet, okay, of course the cash is there. What does this accounting standard say is, now you have a deposit of 10 million from your customer and you have given a loan of 5 million to the same customer. Okay. Now, can you offset these two? That is the loan against the deposit. And I will show only a deposit of 5 million. Let me explain it on the board, and it will be very clear to you all. Right. Now, you have a loan of 5 million from a customer. You also have a deposit from the same customer of 10 million. Of course, you have cash on the other side, let's say 5 million. Right? So your assets and liabilities are equal. Now the question is, when I am preparing financial statements, I know this loan is given to customer A and the deposit is also from customer A. So what do? I remove this loan and set it off against this and show deposit as 5 million. Now still the balance sheet balances. You see, here also 5 million, here also 5 million. The balance sheet will balance. But this is wrong presentation. This is wrong presentation. What you have done here is offsetting. So the accounting standards does not permit you to do offsetting. It could be assets or liabilities, or it could be income and expense, whatever. As per the accounting standards, you should not offset any asset or liability or income or expense unless a particular accounting standard specifies that you can offset. Okay, if the accounting standard says yes, look, you can offset, then you can do. Otherwise, the accounting standards does not require or permit you to do offsetting when preparing financial statements. Okay. So I hope you would have understood what is offsetting is. Then, of course, I need not talk about the presentation of comparative information. As I told you, you need to present at least 2 years of financial information in your primary financial statement. That is, if you are preparing for 2020, you have to produce 2020 and 2019. If you are doing it for 21, then you have to provide 21 and 20. Okay.
Excuse me, sir.
Yeah.
Sir, could you please repeat the aggregation?
Aggregation. Right. Okay.
Yes.
I'll show it to you on the board itself. Then it will be easy for you all to understand. Right. So now let's assume you have assets. Okay. So you have cash. So much of items are there. Right. Now, when it comes to fixed assets, you might have property. Property means your land and buildings. Okay. Then you might have plant, like machinery, or you might have your factory plant. Those are your plants. And then you might have equipment. We call it as equipment. What do you mean by equipment? Equipment is you might have computers, you might have tables and chairs. So we put everything into the class of equipment. So now you have three classes here. You have three classes: class 1, class 2, class 3. Now, if you classify them like this in your financial statements, your financial statement will be very lengthy. Very lengthy. So, what does the accounting standard say? If you have items which are of similar class, you can aggregate them. So, what happens here? Let's say property is 10 million, this is 3 million, this is 2 million. So altogether you have 15 million. So you can show it like this in your financial statement, but it doesn't make sense. What the accounting standard says, you can group them together. You can group them together. We will say property, plant and equipment, PPE. That's why we call it as PPE. Why you say PPE? Property, plant and equipment. So I group these classes into one and I will put 15 million. Now see what I have done. I have aggregated. Aggregated means total. I have total or grouped, whatever you may call it. So by doing that, I have reduced the financial statement presentation. Otherwise, it will be very, very lengthy. So when it comes to the presentation of financial statements, over the years, people have looked into these financial statements, have found how you can group these or how you can aggregate them. Based on that only, now the current formats provided to companies are made up of. Central bank have looked into how the banks can present their financial statement. normal companies, the accounting standard itself specifies how you present it. So companies over the years and the standard setters and the preparers all have identified how these financial statements can be presented. So aggregation is that how you can group similar classes of assets or liabilities. It could be liabilities also. You can group them together. Is it understood?
Yes, sir. Thank you.
Okay. Right. So disclosure of accounting policies. So as I told you, how best you have adopted the accounting standard that you have to provide by way of your accounting policies as a disclosure. So you have the measurement basis, how you measure your assets and liabilities. Then you need to provide your specific accounting policies to understand better. And it has to be very clear and understandable if the essential that the financial statement should disclose the accounting policies used in their preparation. Why? Because a reader will not know how you have prepared the financial statements or what are the assumptions that you have used. So a reader can understand better when you provide the accounting policy. Okay, later on we will learn LKS 16, which talks about property, plant and equipment. So there you will talk about depreciation. How you provide depreciation for your property, plant and equipment. Now this depreciation policy may vary from company to company. So a reader would like to understand what is the policy that you have adopted for depreciation. That is very, very important. Okay. So disclosure of accounting policies is very, very important as part of your financial statements. So the LKS 1 requires certain financial information to be provided okay, certain information to be included in the financial statements itself. For example, the name of the reporting entity. Okay, so for which company you are preparing the financial statement. Whether the accounts cover the single entity only or a group of entities. So I explained this. Whether you are preparing for the parent or for the groups where you will have some subsidiaries also involved in the company. The date of the end of the reporting period. So if your financial year is 1st of January to 31st December, the 31st December will be your date of the end of the reporting period. And of course, the presentation currency. In which currency you are going to present your financial statement, whether it is Sri Lankan rupees or US dollars. So it depends mostly in the country where you are domiciled or you are operating. So since we operate in Sri Lanka, the companies in Sri Lanka mostly provide their financial information in Sri Lankan rupees. But you might also provide it in US dollars. That is, when you want to attract investors, the investors would like to know in terms of dollars. What is the asset worth of this company in terms of dollars? Or what is the profitability of this company in terms of dollars? So, for investors or from foreign companies, they would like to know how the performance of the company has been in terms of dollars. So for those requirements, we will provide additional financial statements in dollars as well. and the level of rounding used in presenting amounts in the financial statement. This is one important aspect when it comes to the financial statements, right? So I just want to take a few seconds on this where I need to just explain you how it is. Now, what is this level of rounding? Now, let's say, how much is this? 1 rupee. Then you have 10. Then you have 100. Okay. Likewise, how much is this?
1 million.
1 million. Okay. How much is this?
1 billion.
So earlier you said 1 million, make me correct. The second one you said 1 billion, BN. Right. How much is this?
1 trillion.
1 trillion, exactly. 1 trillion. Do we have companies in Sri Lanka with a trillion value amount in their balance sheet? Do we
Yes.
have?
Yes.
Yes. Now there are a lot of companies coming up with trillion values in your balance sheet. Now just imagine you are going to look at a balance sheet where it is in trillions. Look how long this number is. Altogether 12 zeros, 12 zeros. And of course, if it is 10 trillion, you will put 10 here. So 3, 6, 9, 12, 14, and in between 4 commas, altogether 18 characters. 18 characters. Now, this is of course, let's say 2020. Now, again, you have to repeat the same thing for 2019. So, when you look at a financial statement, what you might see mostly is numbers, long numbers, which might look like very distracting. Okay. So, when you present a number like this, we say you are presenting it in rupees. Okay. When you present a number like this is 10 trillion rupees, 10 trillion rupees. So I have presented it in rupees. That is what it means. Now what I do, I remove this part. Now what is this number is? Can somebody tell me what is this number is now?
$10 million.
10?
10 billion rupees.
This
Billion.
all is billion. 10 billion. But what was the company's worth actually? Now earlier they were 10 trillion now. So just because I remove these 3 zeros, can they come down to 10 billion? That's wrong. You can't do that because they were a 10 trillion company. Now just because I remove these 3 zeros, they cannot come down to 10 billion. Still they have to be 10 trillion. So what do I do? What do I do?
Rupees in thousands.
Ah, there you are. I will bring that in here. Rupees in thousands. Rupees in thousands. Now how will you read this? When you read this number, in your mind, you should have 3 more zeros. What will happen now? It becomes 10 billion, 10 trillion again. Do you understand that? Is that clear to you all? So when you read the number, you read this number and 3 more zeros so that you get the 10 trillion. Right. Now what do I do? Now what is the number? Now what is the number?
10 million.
Now it is 10 million. But what is actually the company's? Company is 10 trillion company. So what do I need to do here?
Rupees in million.
Very good. Simple as that. Rupees million. That's it. So when I say rupees in million, what will I do? When I read this number, I will have this and I will put another 6 zeros. That's all. So the reader will see only this, but on top they will see rupees million. You see, this is what called level of rounding. Do you understand that? Do you understand that? This is very, very important, because when you look at financial statements, first you need to understand what is the level of rounding that they have used. Even in your examination questions, what happens? Sometimes the trial balance would have been given in millions or in thousands, but the adjustments would have been given in rupees. So you need to convert it accordingly between the millions, thousands, and the rupees. So the level of rounding is very, very important when it comes to the financial statements. You prepare financial statements in full rupees, but later on, when you present them, you need to make a decision. How will it look like when I present it in full rupees? Or when I put it in thousands? Or when I put it in millions? Or you can go to the extent of showing it in billions also. So when you want to make the number smaller and smaller, you can extend your level of rounding. Is that understood? So just take this as an example so that when you look at back, you will understand. Just make a note of it. Okay? So currently, if you remove all these, you will have to say rupees million. Rupees million. Okay? Right. So that is about level of rounding in the financial statements. So how items are disclosed? Now I showed you the list of items like the cash, starting from cash, property, plant and equipment, and so on. So we call it as some items must appear on the face of the statement. When you say financial statement, the statement that you see is called a face of the financial statement, right? So when you see the face of the financial statement, you need to see certain items appearing there. Certain items might appear in the notes of the financial statements. Okay, so other items can appear in the note to the financial statement. The recommended formats are given which entities may or may not follow depending on their circumstances. So as I told you, you can refer to the accounting standard, which I'm not going to give it to you now, no point. The format of the financial statement is described in the or prescribed in the standard. So people can adopt that, or they can include more or reduce. It doesn't matter. As long as they follow the principles, their presentation is okay, right? Statement of comprehensive income. So now we are going into the basics of the three financial statements. The first one is the statement of comprehensive income. So in other words, this is your P&L or the performance. So the statement of comprehensive income, the term the term statement of comprehensive income came into effect from June 2011 actually. That is where when the LKS1 was first published in 2011. That is, the companies in Sri Lanka underwent a major change in financial reporting in 2012. Right? Way back in 2012, that is about almost 9 years back, all the companies in Sri Lanka underwent a major change in terms of financial reporting, where they had to adopt a new set of accounting standards for financial reporting. So when that happened, even LKS1 underwent certain changes and it brought in these new terms for financial statements. That is where these new terms, statement of comprehensive income, statement of financial position, all those came in. Earlier, we called it as balance sheet, profit or loss statement, likewise. Now it has got changed. So the amendment brought in a new change to the financial statement. That is, you can now call this statement of the P&L in two ways. One is, you can call it as the statement of comprehensive income. That is one way of doing it. Or you can call it as statement of profit or loss and other comprehensive income. So there are two components. One is the statement of comprehensive income. The other one where you say statement of profit or loss and other comprehensive income. So how companies do today to simplify this is they provide a financial statement called income statement. They have gone to another level now today. They call it as income statement and they give the basic information like earlier the profit or loss. Then they provide another statement to say that statement of comprehensive income, that is the SOCI. And the SOCI will include the results of the income statement. I'll show it to you now in a short while. When it comes to the statement of financial position, LKS1 talks about certain distinctions. Okay. So before we move on to that, I'll just try to show you some important information. So what I'm going to do now is actually, I'm going to show you, pardon me for selecting this for this purpose. I'm just going into this website of commercial bank, which is easy for me to show and explain. So I'm going into that. You can download this and have a look at it. Likewise, you can download any company's annual report for that matter. I'll just try to go through the interactive session and explain you how the financial statements will look like. You can see the screen, right? Can you all see this?
Yes, sir. Yes,
Right.
sir.
So now what we are going to do is, you see, under financial statements, we have the income statement, right? Okay. Now look at this financial statement. So it says income statement, right? And you have this company, you see here, Commercial Bank of Ceylon PLC, and they say annual report 2020. And when you look at the columns, look at the columns. So this is for the year 2020. So what you have here is the column representing the numbers for 2020. But as specified in LKS1, what you should do, you should present the financial information for 2019 as well. For what purpose? Anyone?
Comparable.
Comparativity or comparability. So when you want to compare, you need to provide that. And also I said, financial statements could be presented for the company or the parent or for the group, right? So the commercial bank has its own performance as well as the group performance. So that's why you see two columns here and again two columns here. Okay. Then of course you observe a change also, that is between these two, what sort of a change in percentages, right? But most importantly, let me try to zoom this a bit. I don't know whether you can zoom it. You need to download it. See whether we can download. Yeah, okay. So right. So now you have the income statement. Right, you have the income statement. Now this is visible better, right? You can see this.
Yes, sir.
Yes, sir.
Now look at this. They say income statement. Here you will see for the year ended December 31. So by reading that, what do you understand? By reading that statement, what do you understand?
Statement for year 2020.
No, the financial year of this company ends in 31st December. You see? So when you are reading it, how do you read it? For the year ended 31st December 2020 will be this column. For the year ended 31st December 2019 will be this column. You see? That is how we read it. And this column represents the group. This column represents the bank or the parent. Right. What else you can see? So they have given comparative. There is one more information which is available to you, which you have learned. What is that?
Notes.
Yeah, notes of course is there. But before that, one simple information that we learned.
Rupees in thousand.
Yes, you see, this is known as the presentation currency, rupees. You see, all the columns are presented in rupees. But going one step ahead,
Level of rounding.
level of rounding is also there. So these numbers are presented in what?
Level of rounding.
Level of rounding in thousands, right? These are in thousands. So when you look at these number, I'm just taking this is just the PNL. So can somebody tell me what is the gross income? Now you see this is gross income, and what is this number? Can somebody tell me this number? How can you read this number? What is the number?
151 trillion.
Look at it carefully. This number.
151 billion.
Okay. Go on, go on. What is this number in full? 151 billion,
966 million
966 million, 400 and
413,000.
13,000. So I can see that most of you all are struggling to read the number. Even though we work with numbers, you should be thorough to read also, right? So I think you might be seeing for the first time like this in a statement, but this is how numbers are presented. So when you go and do credit appraisals or credit evaluations, you might get financial statements of companies like this. So before going into details of the financial information, you need to know these basics. For which period it is, what is the currency, what is the level of rounding, what does this figure means actually. So some might read it as 151 million. Fine, but their evaluations will be based on that. Actually speaking, it is 151 billion. So you have to be very careful. When you are reading financial statements, these things are very, very important. Right. Now, let me go back to another financial statement. Let's see whether we can look at another one. Let's see annual report of so you can view any company, it doesn't matter. I just want to show it to you all so that you know how it look like, so you can later do your own searching. Right. This is a different company I have taken. This is Haley's, right? This is Haley's. Now look, this is their statement of profit or loss. They call it as statement of profit or loss, right? What else you can see? What else the information that you can see? Yes? What can you say?
For the year ended
31st
of March.
Yeah. What does it mean? Their financial year is from when to when?
1st of
April
April to
2019.
31st March.
1st of April to 31st March. So 1st of April to 31st March means it will go across 2 years. 1st of April of this year into 31st March of next year. Right. Now when you read the financial statement, let's see what it is. For the year ended 31st March 2020, what does it mean? Now tell me. This is the performance of this company. This column, particular column, will relate to from 1st of April 2019 to 31st March 2020. If that is the case, now tell me for the year ended 31st March 2019, when I read that, what does that mean? What does that mean?
From 2018 April 1st to 2019 March 31st.
Very good. Now you have to be very careful. That's what. Now this talks about from 1st of April 2018 to 31st March 2019. Okay. But both are for respective financial years. It doesn't matter. But these are going across 3 years. This is from 2018 April to 2019 March. This is from 2019 April to 2020 March. Right? Right. Then what else? They say rupees again. It is presented in rupees, and the numbers are in thousands. The numbers are in thousand. Now, let us try to read this number. See whether you can read it. What is this number?
Two hundred and ten billion.
210.
210 what?
10 billion.
Million.
307 million. 3000.
3000. 210 billion, 307
7
million.
million 3000.
Okay. Good. Could you please mute? Then, as I told you, you will see now here they have done their statement of profit or loss, and now they give their statement of comprehensive income. This is what we learned. Now, when you look at their statement of comprehensive income, it is again the same thing, but look at the starting point. Look at the starting point. Now, the starting point is actually the closing point of this profit or loss. You see, what is the closing point? You see, profit for the year. Profit for the year 2894,792. When you look at this, the opening starting point of the comprehensive income is the closing point of the P&L. Okay, 2894,792 is here. Then we have the next statement, which is called the statement of financial position, right? Why I took this is I just want to show you, which takes us to the next topic actually on LKS1. So look at the statement of financial position, and it says as at 31st March. Now what is this? This is the last date of your financial year. So you are giving the balance sheet or the statement of financial position as of this date. And again, same information is given. 2020 rupees, thousands, all those are given. But look at this. This is somewhat very important. Now, I hope you can still see it. Right. I'll take this little bit. Now, this is the assets. The assets are starting here. And you have a caption called non-current assets. And then you have a caption called current assets. And then you have the total assets. Okay. Now look at this, how it is presented. Let's see, I can, right, okay. Now it is visible, I believe, right? So when you look at the assets of the company, it has a breakdown saying non-current assets and then current assets. That is how it is broken. Now let's go to the statement of financial position of commercial bank and see how it looked like. Right. Okay. Let's try to download this and then get it. Right. Now look at how the assets of commercial bank look like. You will see a clear difference. Now how they have presented their financial statement. Look, assets, and this is how they present it. Now, do you see any difference between the two companies? What is the difference? Anyone?
In Haley's company, they are dividing into two groups.
Yeah. What are the two groups?
Non-current
Non-current assets
and current assets.
Right. Now, what is commercial bank doing?
They are presenting all together.
All together. So I was talking about the class, item class. These are the item class, right? These are the items. So you will see the similar items here also, cash and so on. Right? Now we have a question in our hand. Why they are showing it like this and why commercial bank is showing it like this. Just take few seconds to look into this, and then I'll go to the other one for you to make a judgment. Why commercial bank is presenting it like this? Okay, just go through the few items. Okay, and why Haley's is presenting it like this? You can go through. If you want, I can zoom it a bit. Do you want me to zoom it? Why I want to keep it like that is to see the entire thing, so that's why. So can somebody tell me why there is a difference between the two companies in presenting the financial statements? What do you think?
Format difference.
Yeah, why? I'm asking why. Why there is a difference in the format? Now we were saying that both are following LKS1, and this is how you should present. Also, yeah.
Commercial bank is bank has aggregated the
Not really. Not really. Now just look at the two companies. What is commercial bank
Commercial
doing?
bank is
commercial is a
following the
bank.
central bank format.
Okay, you are somewhat there. But more than that, commercial bank is what? A financial institution, right? Do you agree? Commercial bank is a financial institution, right? What is
Liquidity
Haley's?
order. Liquidity order.
Haley's is a trading organization. Okay? It's a trading organization. They do trading. They are not a financial institution. So because of that only, there is a difference. Right? Now, why there is a difference? That you need to establish that first. Because Haley's is a trading organization, commercial bank is a financial institution. So when it comes to the financial institution, not because of that it is a bank, more than that, it is a financial institution. So there is a clear difference in presenting financial information between a trading organization and a financial institution. The trading organization has to present its financial information when it comes to the asset or the liabilities in this format, where they have to say non-current assets and current assets. I can show you the liabilities also. You will see the same thing. You see, liabilities also, non-current liabilities, current liabilities. But when it comes to commercial bank, you see their assets are put together, liabilities are put together. So why? When it comes to a financial institution, they need to present their financial statement in the order of liquidity. In the order of liquidity. I think somebody said liquidity order. Good. So we need to understand why the presentation of these two companies differ. Right? Why the presentation of these two companies differ? Because commercial bank is a financial institution. Because of that, their presentation order is different to that of a trading organization like Haley's. Okay, so commercial bank or the financial institution, they present their financial information in the order of liquidity, and that is in the order of decreasing liquidity. Decreasing liquidity. So which means the most liquid item will be at the top. You see, cash and cash equal. But when you go down, you see, you are ending up with other assets, deferred tax, intangible. So these names are still not known to you all. We will learn it gradually. Here you see property, plant and equipment. Here, can you see that? Right. So this is in the order of decreasing liquidity. Now let's go to Haley's. Look at Haley's. I'll just zoom it a bit and then we'll go scroll down. Right. Sorry. Right. Look at this. Where are they starting? Non-current assets. So they say property plant. They are property plant and equipment is at the top. You see? Whereas in commercial bank, it was at the bottom, isn't it? You see? It was here. At somewhere close to the bottom. But here they are having it at the top. So what is happening there? There also you get an order. What is happening? Where do you get cash? Cash is at the bottom. So what is that order?
Increase in liquidity.
Increasing liquidity. So that is the clear difference between the presentation of between the two companies. What is the difference? In one entity, it is in the order of increasing liquidity. In the other organization, you have it in the order of decreasing liquidity. Do you all understand that? Okay, is that clear? So the homework for you all is you are going to find out for me next week 5 companies which have presented in the order of decreasing liquidity and 5 organizations which have presented financial information in the increasing order of liquidity. Okay, one is on the decreasing, one is on the increasing, right? You have to leave out the Haley's and the commercial bank. You can't take those two. You have to find out 5 entities for both. That is 5 entities which gives you from the increasing order of liquidity and 5 in the order of decreasing liquidity, because you are going to give me the company names. Okay, I will call upon few and you will have to give me the names of the companies, right? So what I'm going to do now is I'm going to stop there, right? I'm going to stop this chapter there, where we will have another 8 or 9 slides there, right? I will do that next week. But in between, I just want to look at the bank reconciliation. So can we go to that, please? Can we look at that? Can we look at this question? Have you all done it? Have you all done it? No response. Why? Was it tough? No one has done it. Okay, let's look at it. You all can see the screen, right?
Yes.
Yes, sir.
Right. So the requirement here is to prepare the cash bank reconciliation for the two, based on the 2 financial statements. So basically, first, what we have to look at is what is the cash book balance that we are trying to reconcile. So the cash book balance is 24,413, which is a favorable balance because this is balance carried forward. So the brought forward will be 24,413. So that is a debit balance. So 24,413 is a favorable balance. As per your cash book, it is a favorable balance, right? Then we look at the bank statement. As per the bank statement, you are starting with a credit balance of 25,000. So when you are going and ending at 32,000 means you are ending at a credit balance of 32,000. So as per our expectation, the balances are in the right direction. That is, the debit balance in the cash, there is a debit balance in the cash book which is 24,413, and as per the bank there is a balance, credit balance, which is 32,237. So the problem here is why these two are not agreed. That is what the question is. So what is the first step? I told you to mark off the items against the debit and the credit. So you look at the debits of the cash book and mark it against the credit of the bank statement. And then look at the credit side of the cash book and mark it against the debit side of the bank statement. So when you mark off like that, what happens? Here, the 25,000 here is appearing here. So that is marked off. The 14,000 here is marked off against this. The 20,204 is not appearing here. So that is a unreconciled item. You can highlight that 20,204. Then when you take the 10,000 which says it's a bank loan, here also 10,000 appears, but we need to be careful with the description also. It says a loan. So that is also marked. So from your debit side, it is only the 20,204 which is remaining. Now, what is this 20,204? That is a deposit that you have made, not yet realized. So, like checks deposited, not yet realized. You see that? Okay. So, in the bank reconciliation, you have found out one item. What is that? Checks deposited, not yet realized. Now, let's go to the other component. Now we are looking at the credits against the debits, right? Check number 1, 1,200. Do we have it? Yes, 1,200 is there. Check number 1. So you can mark off. Second one, stationery. Check number 2, 38. Look at whether we have 38. That is not there. So what does that mean? This is an unreconciled item. The 38 is an unreconciled item. So what do you mean? You have issued a check. That's why you have recorded it in your cash book. So this check is not yet presented for payment. If it was presented, it will appear here. So now here comes the second type of difference. That is checks issued, not yet presented. Okay. So we have one item. We need to go through the remaining. Business rates, 2,400. Here, 2,400. But here you make an assumption. 2,400, they say standing order. Now, how will you compare these two? We make an assumption. That is, for the business rates to pay to the municipal council, you would have given a standing order to the bank. Look, every month or every year on this time, you deduct 2,400 from my bank account and pay it to the municipal council. So this 2,400 can be marked against this, right? So this is marked, this is marked. Then we have 145, check number 3. Do we have it here? Yes, 145, check number 3, marked. Check returns, 12,600. Do we have a 12,600? Yes, here. Check dishonor. So that is also marked. Motor vehicle, check number 4, 28,000. Do we have this 28,000 here? No. Then this comes the second unreconciled item. For a motor vehicle, you have paid, this is actually for a maintenance or some, but we don't know. You have given a check for 28,000, check number 4. But the person who received your check has not yet presented to the bank. That's why it is not appearing here. So this is another item. So this one remains, this one remains. Last item, cash, check number 5, 600. 600 is there, check number 5. So basically, On this side, you have this 20,204. On this side, you have this 38 and this 28. Similarly, we have to go and look at what are the remaining items in the debits and credits of the bank statement. So on this side, you know, all were marked. On this side, are there any items remaining? Are there any items which are not marked? Bank charges. This 10 rupees. Can you remember? I told you bank charges, the person who is maintaining the cash book doesn't know. Bank charges may differ. So until the bank puts it in their bank statement, they will not record it. Okay, that's why it doesn't appear. So if you have a debit here, correspondingly, you should have put a credit here. But why you haven't put it? Because you don't have any evidence. There is no source document. So the source document will be when you receive the bank statement only, it will be the source document to record this. So next month, you will put that 10 here. But right now, that becomes an adjustment. That 10 rupee becomes an adjustment. So what you need to do, even though you say the bank balance is 32,237, you may have to remove this 10 from the bank statement balance. Otherwise, it will not match against this. So now we have three types of items. One is deposits not yet realized, checks issued not presented, and also an adjustment. So when you put down these three, your bank reconciliation should agree. How will it appear? It will appear like this. So where you will start? I'm starting with the balance at bank as per cash book, which was 24,430. I'm going to adjust the bank charges because I have not accounted for it. This is my adjustment. So bank has already deducted this 10 rupees, but I have not deducted. So I'm going to deduct that. So I have the corrected balance 24,403. Now I have my elements. What are those? You will add the checks issued not presented, and you will deduct the deposits awaiting realization. Then you will get the balance as per bank statement, which was 32,237. So this is the step-by-step approach for the bank reconciliation. Any questions?
Excuse me, sir. I have started from the bank balance as per the statement.
Bank statement, right?
Yes.
Right. So as I told you, if you had started with the bank statement, what will happen? The entire thing will get reversed. So your bank statement balance will go here. This will come here. When this goes here, what will happen? Individually, all these items will get reversed. So what happens? Which means if you are starting from the bank statement, just see. If you are starting from the bank statement, this 32,237, what is the outstanding item here? Is 10 rupees. So what you need to do? 32,237, you need to add this 10 rupees. You need to add this 10 rupees. So let me show you on the board. Right. So if you have started with the balance as per bank statement, it will be 32,237, right? Correct?
Yes.
32,237, right? So to that, what you need, you will add the bank charges, 10 rupees. So it becomes 32,247. Then what do you do? You have to reverse what you have done previously. That is, add deposits not realized, because in the cash book you have put those as a deposit, but the bank has not yet considered it. So the 20,204 will be a addition less checks issued not presented. How much is that? 28,000, not 38. Then you should get balance as per cash book. So I think it should give you the answer. Let's see whether yeah.
Excuse me, is it necessary to prepare a adjusted cash book in the form of T account in order to adjust that bank
No.
charges 10 rupees?
Not really, but it depends on the question. Sometimes the examiner, so this gives you the answer 24,413, right? But what happens, sometimes the examiner might insist on preparing an adjusted cash book. Okay, so in such instances you might have to do a T account or maybe say some working to prove that the adjusted cash book balance will be 32,247 minus 10. It's not necessary. Now say the bank reconciliation statement, we can do it like this also, where you put the adjustment also in this. Now this is basically an adjustment.
Sir,
Yeah.
so can we do the bank reconciliation statement in both ways?
What do you mean by both ways?
Like to take the bank statement balance or the cash balance?
Yeah. That is okay. You can do the reconciliation in any way that you want, because there is no restriction as such. You can start from here or you can start from here. Now in the slide that I showed you, I started from here now. But since one of you wanted, I started with this. It doesn't matter because both will give us the same answer. What is our ultimate objective? Either I want to achieve from here to here or here to here. That is what my objective is. So sometimes what happens, the examiner might want you to start from the cash book and they want you to adjust this 10 rupees and then arrive at the bank statement balance. So you have to read the question carefully and understand. Depending on the question only, you have to start. Now sometimes if they are silent, you can start anywhere, either from this or from this. But what you need to remember is what you do in between, right? Erroneously, if you go and put this here and do this, your entire thing is wrong. So you have to remember, if I start from the bank statement, I need to do this. If I start from the cash book, I need to reverse this. That is, I will add the checks issued not presented and deduct the deposits not realized. I think somebody asked a question. Is business rates and standing order are similar? No. I don't know. Do you know what is a standing order is? Standing order is an instruction that you give to the bank. Like say now you want to pay your mobile bill. Every month you know that your mobile charge is somewhere around 1,000, right? So since you forget, what you can do is you can go and ask the bank, look, can you make a monthly payment of 900 rupees from my bank account to the mobile service provider? So bank will do. That instruction is known as a standing order. But business rate is not that. Business rate is where to run a business, you have to pay municipality tax. So in this particular question, what this person has done is, since he forgets or maybe say he doesn't want to get bothered about going and paying, he gives instructions to the bank to pay this amount on his behalf. So what the bank will do, as per the instructions on that particular day, they will deduct it from his bank account and pay it to the municipal council. Okay. Then there is another question, sir. Is it okay to do the adjustment separately and add to the reconciliation statement always? Yeah, that is okay. You can do this part separately. You can do this part separately and then bring in from here. You do it. From here you do it. Okay. Again, you can't go back to this balance. You have to remember that. Once you have adjusted it separately, you have to start from here and do the bank reconciliation. That is okay. No problem there. Any other questions? Right. So let's stop there. So we have a few more questions on bank reconciliation and also the remaining part of LKS1, which we will try to cover it next week. And then I quickly start on with the next topic, because I don't know whether the exams are going to be held in October or whatever, but we'll try to finish off the syllabus quickly so that we can do some revision if time permits. Okay. Right. Are there any other questions? No? Right. So then we'll meet up next week. Take care and goodbye.
Sir, excuse me.
Yeah, go ahead.
Sir, there is a standing order in the bank
Statement.
bank statement, but
Yeah.
there's no evidence in the bank account in the business.
No. What that is, you are looking at the cash book, right?
Oh.
Yeah. So what you need to do is you have to match the items. First way of matching is with the amount. Okay. So I think both had the same amount, no?
Yeah.
The standing order and the cash book, there was an amount of 24,000. So what does it mean is, first we have to go by the amount, and then you have to look at the description. So of course, in this particular question, those two had two different meanings. Like one had the caption as standing order, and the other one had like, let me take that. Yes. So here, this had the business rates description as business rates 2,400. Here it is 2,400. So first we go by the amount, right? And then we look at the description. So here, of course, you have to make a judgment, right? So you have given a standing order. So for what kind of thing that you will give a standing order will be for something like a business rate. Okay. In normally, don't worry too much, because in the examination, mostly you might get the item similar, right? So you don't have to worry too much. This is, I just want to make little confusion in y'all only. I just made it like that. But in examination, it won't be that much complicated. They will just give it to you more straightforward. So you can look at it when you look at the past paper questions, you will understand that. Okay.